On January 23, 2025, Larry Fink, the CEO of BlackRock, made a notable appearance on CNBC's Squawk Box, where he articulated his strong advocacy for the U.S. Securities and Exchange Commission (SEC) to expedite the approval of the tokenization of bonds and stocks. This stance comes at a time when the financial world increasingly looks toward blockchain technology and digital assets as transformative tools that could reshape the market landscape.
The concept of tokenization. Tokenization refers to the process of converting physical or financial assets into digital tokens that can be recorded and managed on a blockchain.
By tokenizing bonds and stocks, these assets can be fractionally owned, traded with greater ease, and made available to a broader audience.
Fink believes that tokenization could significantly enhance liquidity and accessibility in financial markets,
allowing both retail and institutional investors to engage more dynamically with their investments.
Broader context of Fink's statements.
During his segment on Squawk Box, Fink also discussed various pressing topics, including the ambitious $500 billion Stargate AI project, the current economic landscape, and the Federal Reserve's strategies to combat inflation. His comments suggest a holistic view of financial markets where advancements in technology such as AI and blockchain play a central role in shaping future investment paradigms.
Market implications of tokenization. Fink's proposal for tokenization carries substantial implications for how investments are managed and traded. By allowing for easier transactions and fractional ownership, tokenization could lead to more fluid and dynamic market activities.
Fink emphasized that such a shift could democratize access to investments, potentially benefiting a wider range of investors,
from individuals to large institutions. Call for regulatory support. A crucial aspect of Fink's advocacy revolves around the regulatory environment. He urged the SEC to act swiftly to provide clear guidelines for tokenization, highlighting the tension between the need for robust regulation and the desire for innovation in the financial sector.
Fink's push represents a call for a supportive framework that not only fosters technological advancement but also ensures market integrity and investor protection.
Public reception and skepticism. Reactions to Fink's proposals have varied significantly.
While some financial experts see the potential benefits of tokenization, there is notable skepticism among the public. Many commentators, particularly on platforms like YouTube, expressed concerns regarding the motivations behind BlackRock's push for tokenization, fearing it could further entrench powerful financial institutions in the burgeoning digital asset space. Issues of market fairness and accessibility were hotly debated, with some users expressing outright distrust of Fink and BlackRock's intentions. Differences in perspectives. Sources covering Fink's statements differed in focus. CNBC's coverage highlighted the economic benefits and broader implications of tokenization, while social media reactions predominantly showcased skepticism and concern about centralized financial institutions' increasing influence in the digital asset market. This divergence illustrates the complex dynamics at play as traditional finance seeks to adapt to the rapidly evolving landscape of digital assets.
Conclusion.
Larry Fink's call for the SEC to approve the tokenization of bonds and stocks marks a significant moment in the discourse surrounding financial innovation. With the potential to reshape market structures and enhance investor access, tokenization could lead to a more dynamic and inclusive financial ecosystem.
However, the mixed public reception underscores the ongoing debates about the balance between innovation and equity in the financial markets, revealing the challenges that lie ahead as regulators and financial institutions navigate this transformative landscape.
Larry Fink, the CEO of BlackRock, has made headlines with his recent statements advocating for the U.S. Securities and Exchange Commission (SEC) to accelerate the approval of tokenization for bonds and stocks.
This push for regulatory action is significant, especially considering BlackRock's influential position in the financial industry. Here are some counterintuitive insights related to this development. 1. Tokenization as a democratizing force. One might expect that the involvement of a major player like BlackRock in tokenization would lead to further entrenchment of existing power structures in finance.
However, Fink argues that tokenization could actually democratize access to financial markets by enabling fractional ownership. The idea is that by converting traditional assets into digital tokens, smaller investors could participate in markets that were previously inaccessible due to high minimum investment requirements. This perspective challenges the assumption that large financial institutions inherently hinder market accessibility. 2. Regulatory clarity versus innovation stifling. It is often believed that regulatory frameworks are necessary to protect investors and ensure market stability, but Fink's comments suggest that a lack of clear regulations is currently stifling innovation in the financial sector. His call for the SEC to act quickly aligns with the idea that bureaucracy can sometimes impede progress. This counters the traditional view that regulation should precede innovation. Instead, Fink implies that a more agile regulatory environment could foster technological advancements. 3. Skepticism about institutional motives. Public reactions to Fink's statements reveal a deep skepticism about the motivations behind BlackRock's push for tokenization. Some commentators argue that rather than democratizing access to financial markets, this move could simply allow BlackRock to consolidate its power in the emerging digital asset space. This counterintuitive view suggests that what appears to be a progressive step for market accessibility might actually serve to reinforce the dominance of established financial institutions, raising questions about the true beneficiaries of such innovations. 4. Market fluidity versus stability. Fink's assertion that tokenization could lead to more dynamic and fluid markets poses a potential conflict with the traditional view that stability is paramount in financial markets. While fluidity can enhance liquidity and trading efficiency, it can also introduce volatility and risks that could destabilize markets. This nuance challenges the binary perspective on market characteristics, suggesting that greater fluidity does not inherently equate to improved market health. 5. Public sentiment and institutional trust. The mixed public reception to Fink's call highlights a broader disconnect between institutional leaders and the general public's trust in financial systems. Many commenters view BlackRock and its CEO with suspicion, associating them with negative attributes like greed and manipulation. This counters the expectation that influential leaders advocating for innovation would naturally gain public support, revealing a deeper skepticism toward traditional financial institutions. 6. AI and financial innovation intersection. Fink's mention of the $500 billion Stargate AI project alongside his advocacy for tokenization may seem like a standard move to align with technological trends. However, it raises questions about the interplay between AI and finance. The assumption is often that AI will streamline operations and improve decision-making within existing frameworks. Yet, Fink's comments suggest that AI could also fundamentally alter how financial products are conceptualized and traded, hinting at a more profound transformation than merely enhancing current practices. In conclusion, Larry Fink's push for the SEC to approve tokenization of bonds and stocks introduces several counterintuitive perspectives on the implications of such technological advancements. While it is easy to view these moves through a lens of skepticism toward financial institutions, Fink's arguments for democratization, regulatory agility, and the intersection of AI and finance challenge conventional wisdom about the role of large players in fostering true market innovation. Larry Fink, the CEO of BlackRock, has made a significant call for the U.S. Securities and Exchange Commission (SEC) to quickly approve the tokenization of bonds and stocks. This advocacy for tokenization, which involves converting traditional assets into digital tokens on a blockchain, is a key topic that merits deeper examination, particularly regarding its implications in the financial landscape and the regulatory environment. Important content often overlooked. 1. Tokenization's potential for fractional ownership. Many discussions on tokenization focus on its potential to enhance liquidity and improve trading efficiency, but the concept of fractional ownership is often overlooked. By converting financial assets into tokens, investors could buy and sell fractions of assets, making investments more accessible to a broader audience. This could democratize investment opportunities, allowing smaller investors to participate in markets that were previously the domain of the wealthy or institutional investors. Significance: this democratization can lead to a more inclusive financial system, potentially increasing overall market engagement and liquidity. However, it raises questions about market stability and investor protection, as inexperienced investors might participate in high-risk investments without fully understanding the implications. 2. Regulatory framework necessity. Fink's emphasis on the need for a supportive regulatory framework is a critical point that is often simplified or ignored. The balance between regulatory oversight and fostering innovation is delicate. While Fink calls for rapid SEC approval, the implications of such a move could be far-reaching, affecting how existing regulations apply to digital assets and potentially leading to regulatory arbitrage if not handled carefully. Significance: a robust regulatory framework is essential to build trust in tokenized assets and ensure consumer protection. The SEC's approach will set precedents for how digital assets are treated in the future, which could either encourage or stifle innovation in the financial sector. 3. Impact on institutional investors. The push for tokenization is often framed in the context of retail investor benefits, but its implications for institutional investors are equally significant. If tokenization enhances liquidity and market efficiency, it could attract more institutional investment into digital assets. This trend could further legitimize the asset class and lead to increased integration between traditional finance and digital finance. Significance: the involvement of institutional investors could stabilize the market and drive innovation. But it also raises concerns about market manipulation and the concentration of power in the hands of a few large players. This could exacerbate existing inequalities in market access and influence. 4. Mixed public reception and skepticism. The public response to Fink's statements reflects a broader skepticism towards large financial institutions and their role in the evolving digital asset space. Comments from social media and various commentators highlight concerns that BlackRock's push for tokenization might serve to entrench its power and influence in the financial markets rather than promote genuine innovation or accessibility. Significance: this skepticism points to a critical need for transparency and accountability in how major financial institutions navigate the transition to digital assets. Understanding public sentiment is vital for regulators and companies alike, as it can shape policy and influence the acceptance of new financial technologies. 5. Broader economic context. Fink's call for tokenization comes during a time of economic uncertainty, with inflation and interest rates being focal points in discussions about the future of finance. Tokenization could be seen as a response to these economic conditions, offering new solutions for managing assets in a volatile environment. Significance: the intersection of economic factors with technological innovation highlights the importance of adaptability in financial markets. As economic conditions evolve, so too must the tools and methods that investors use to manage their portfolios. Conclusion: Larry Fink's advocacy for the SEC's approval of tokenization represents a pivotal moment in the financial sector's evolution. While the potential benefits of increased liquidity, fractional ownership, and greater market efficiency are compelling, the nuances of regulatory frameworks, institutional impacts, public sentiment, and broader economic contexts are equally critical. Each of these factors plays a significant role in determining the success and fairness of the transition to tokenized assets. Recognizing and addressing these often overlooked elements will be essential for stakeholders as they navigate this transformation in financial markets. 1. Tokenization concept. Larry Fink's push for the tokenization of bonds and stocks signifies a transformative shift in financial markets. Tokenization, which involves converting traditional assets into digital tokens on a blockchain, promises enhanced liquidity and accessibility. This could democratize investment opportunities by facilitating fractional ownership, allowing smaller investors to participate in markets previously dominated by larger entities. 2. Regulatory environment. Fink's call for the SEC to expedite approval of tokenization reflects the critical intersection of technology and regulation in finance. The need for a supportive regulatory framework is paramount to ensure that innovation does not outpace oversight. Fink's emphasis on swift regulatory action underscores the tension between fostering technological advancement and maintaining market integrity, which will be crucial for the future of digital asset integration. 3. Market implications. The potential implications of tokenization on market dynamics are profound. Fink suggests that integrating blockchain technology could lead to more dynamic and fluid markets, ultimately benefiting both retail and institutional investors. This transformation could change how investments are managed, introducing new trading mechanisms and potentially altering the structure of financial transactions. For public reception and skepticism, the mixed public reception to Fink's proposals highlights a broader skepticism regarding the motivations behind BlackRock's push for tokenization. Some commentators express concerns that such moves could further entrench large financial institutions in the digital asset space, raising questions about market fairness and accessibility. The discussions surrounding Fink's statements reflect ongoing debates about the implications of financial innovation for equity in investment opportunities. 1. The introduction of the Euro 1999. The launch of the Euro was a transformative moment in European finance. It aimed to unify the currencies of several European nations, enhancing trade and economic stability across the Eurozone. Similar to the call for tokenization of bonds and stocks, the Euro's introduction faced scrutiny regarding regulatory frameworks, market impacts, and concerns over centralization of financial power. Critics worried about a loss of national monetary control, while proponents argued it would foster greater economic integration and efficiency, paralleling the discussions surrounding the tokenization advocated by Larry Fink. 2. The dot-com bubble. Late 1990s, early 2000s. The surge in internet-based companies led to speculative investments in technology stocks. This period was marked by rapid innovation in the tech sector, akin to the current push for blockchain integration. Investors were drawn to the potential of the internet to transform business, similar to how Fink sees tokenization revolutionizing asset management. However, the lack of regulatory oversight and the speculative nature of investments led to a significant market correction in 2000. The aftermath prompted discussions about the need for stronger regulations in rapidly evolving markets. Echoing Fink's plea for clear regulatory guidance in the context of digital assets. 3. The financial crisis. 2007 to 2008. The global financial crisis highlighted severe flaws in financial regulation and oversight, particularly concerning derivatives and mortgage-backed securities. The crisis led to widespread economic turmoil and prompted a re-evaluation of financial practices and regulatory frameworks, much like the current discourse surrounding the tokenization of assets. As Fink calls for regulatory support for new financial technologies, the lessons from the crisis underscore the balance needed between innovation and regulation to prevent systemic risks, a sentiment that resonates strongly in discussions about the future of digital assets and tokenization. Future outlook. Predictions on tokenization of bonds and stocks. The call by Larry Fink, CEO of BlackRock, for the SEC to expedite the approval of the tokenization of bonds and stocks marks a significant inflection point in the intersection of traditional finance and blockchain technology. As we look ahead, several predictions can be made regarding the future implications of this push for tokenization. 1. Increased adoption of tokenization in financial markets. As regulatory frameworks evolve, we can expect a surge in the adoption of tokenized assets. If the SEC approves tokenization, we may see a wave of financial institutions, investment firms, and even smaller startups rushing to tokenize a wide array of assets. This could lead to a more diverse market where traditional assets such as real estate, commodities, and securities are represented as digital tokens, enhancing liquidity and accessibility. 2. Enhanced market liquidity and accessibility. Tokenization is likely to democratize access to financial markets by allowing fractional ownership. Investors who previously could not afford high-value assets like certain bonds or stocks will have the opportunity to invest in smaller portions. This could lead to increased retail participation in markets historically dominated by institutional investors, thus broadening the investor base and stimulating market activity. 3. Shift in regulatory landscape. As Fink emphasizes the need for a supportive regulatory environment, we can anticipate a shift in the regulatory landscape surrounding digital assets. The SEC's response to this push will set a precedent for how other regulatory bodies worldwide approach tokenization. Countries that adopt a favorable stance toward tokenization may see an influx of investment in tech companies, further fostering innovation within their financial ecosystems. 4. Potential for new financial products. Tokenization could spur the creation of innovative financial products. For instance, new investment vehicles could emerge that combine traditional asset classes with blockchain technology, such as tokenized ETFs, exchange-traded funds, or tokenized bonds that offer unique benefits like programmable payouts. This innovation could attract tech-savvy investors looking for novel investment opportunities. 5. Impact on market dynamics. The introduction of tokenized assets may alter the existing dynamics within financial markets. With tokens being tradable 24/7 on various platforms, market volatility could increase, leading to faster price adjustments and potentially more significant speculative trading. This could also prompt traditional exchanges to adapt their trading mechanisms to accommodate this new form of trading. 6. Challenges and skepticism. Despite the potential benefits, skepticism remains. Critics argue that tokenization could further entrench large financial institutions like BlackRock in the emerging digital asset space, raising concerns about market fairness and accessibility. Additionally, technical challenges related to security, scalability, and interoperability must be addressed to ensure the successful implementation of tokenization. 7. Integration with emerging technologies. The future of tokenization will likely intertwine with advancements in other technologies such as artificial intelligence (AI) and decentralized finance (DeFi). For instance, AI could be used to analyze tokenized assets for investment opportunities, while DeFi platforms may provide new ways to leverage these assets for lending and borrowing. This integration could lead to a comprehensive ecosystem that enhances capital efficiency. 8. Global competition for leadership in digital finance. As countries and regions vie for leadership in digital finance, those that embrace tokenization and create favorable regulatory environments may become financial hubs. The U.S., under pressure to act, might either lead the way or fall behind other countries that are quicker to adopt these innovations. The global race for digital finance supremacy could influence international capital flows and investment patterns. 9. Evolution of investor education and literacy. With the advent of tokenization, there will be a pressing need for improved investor education and literacy regarding digital assets. Financial institutions including BlackRock may take the initiative to educate investors on the benefits and risks associated with tokenized investments, ensuring that retail investors are well informed and capable of making sound investment decisions. Conclusion. Larry Fink's advocacy for the SEC to approve the tokenization of bonds and stocks represents more than just a call for regulatory action, it signals a potential revolution in financial markets. If realized, tokenization could lead to a more inclusive, innovative, and dynamic financial landscape. However, the journey ahead will require careful navigation of regulatory, technical, and market challenges to fully harness the potential benefits of this transformative technology. As the dialogue around tokenization evolves, stakeholders from all corners of the financial ecosystem will need to engage thoughtfully to ensure a balanced and equitable future for all investors.